forward markets and contracts. Essentially, this chapter or this reading on derivatives and forward markets takes off where level 1 left off. And the link with level 1 is so strong that the first 3 segments of this reading are simply a cut paste from level 1. So if you look through the curriculum, the reason this book is so thick is half of it is level 1 derivatives. So the whole level 1 derivatives, the good thing is if you forgot or you've lost your level 1 derivatives book, you have it all with you still in case you are itching to recall what is said in level 1. So I'm not going to spend much time on this. I'm just going to give you a 5-minute refresher on level 1 forward contracts. The focus of level 2 is pricing and valuation. So in level 1, we basically understood what a forward contract is, we understood what futures are, we understood what options are, but now we are going to actually value them, price them and value them. And I'm using those 2 terms, pricing and valuation, because there is a major difference between these 2 terms. And the key to understanding this reading is to understand the difference between these 2 terms. So the meat of this reading and what we need to do from a level 2 perspective is this section. And then section 5 is just one slide which talks about credit risk. There are a couple of core points. Once you get those, you are done with this. And then section 6 is not even mentioned as a learning objective. So all I'll do with section 6 is read the 1 paragraph summary on the role of forward markets. Let's get started. The first thing I'll do is a 5-minute summary of what you should remember from level 1. What is a forward contract? A forward contract is a deal or a contract between 2 private parties, let's say counterparty A and counterparty B. Let's say that we are A, the long party. So essentially in a forward contract, we write this document where in this, so this is the forward contract. The contract is nothing but a piece of paper in which both A and B write something, effectively saying that if today is, let's say, 8th of April, in this document we write that on 31st July, party A will buy an asset, let's call that asset XYZ, for $50 on this day, and B is committing to sell this asset to A for 50. So B is called the short party. What's the advantage here? The advantage is both these parties are hedging their risk. So A now does not need to worry about what the price of this asset will be on 31st July. A is locking in a price because A needs that asset on that day. B is also maybe hedging its risk because B has the asset, it needs the money on 31st July, so it is locking in the price that it will get. So both parties have locked in a price, so in a sense both parties are hedged. Okay, now what is the, so does any money change hands at the start of a forward contract? No, so nothing changes hands at the start of a contract. So that's the basics. Now, what is a equity forward contract? If this underlying asset is a stock or equity, or maybe it is let's say index. If it's equity based, then we say it's a equity forward contract. If the underlying is a bond, then it's a bond forward contract. We can also have forward contracts on interest rates, so those are called forward rate agreements. We can have forward contracts on currency, where we are saying that A says that on 31st July I want to buy $10 million at 93 rupees to the dollar, so that would be a forward contract with currency. Okay, so all of you knew this already. This is just the foundation that we will build on. Alright, so what I'm going to do now is give you the most important parts of this reading, which should be sufficient for you to answer the questions at the back. So this is essentially excerpts from the curriculum and excerpts of the most relevant piece. And we will understand this material through example. You will see in general in this reading an immense amount of terminology. and I will actually show you some of that terminology, and I can't imagine how anybody in their right mind can remember those formulas with those terminologies, but the underlying concept is very straightforward. Okay, so let's go through the concept and then the relevant formulas we will memorize. Say you want to get into a forward contract. The spot price of the asset that you want to go long on is 72.50. The risk-free rate is 8.25 and the contract is for 5 years. What should the forward price be? Say you want to, so here okay, so let's say you are selling the forward contract, which means that you are taking a short position. All right, so what can you do here? The price that you set, so let's say this is our forward contract, so this is the piece of paper. On this piece of paper, we'll say that this asset will be delivered after 5 years. Okay, so it will be delivered after 5 years. Now, the price at which it is going to be delivered, this is called the price of the forward contract. Okay, now how do you determine this price? That's what we are going to look at. The current spot price, so this is how much the asset is worth today. The current spot price is 72.50. Okay, now you are going to sell this after, so you are going to sell it after 5 years. I'll give you the formula and then explain the logic for the formula. The forward price is given by the forward rate is equal to the spot price into 1 plus the risk-free rate to the power of t, where if now is time 0, this big T is used as the number of years till the maturity of this contract. So when the contract matures, then what happens? That's when the long needs to get the asset and the short is delivering the asset. Okay, so according to this formula, what do we do? The forward price would be simply 72.50 into 1.0825 to the power of 5. So this is equal to 107.7. Okay, so this represents the forward price, and you can on your calculators you need to figure out how to do this fast. That's all level 1 stuff. Okay, the way you can now look at this is as follows. What's the logic for this formula and why do we use the risk-free rate? You could, in a sense, so if you buy the asset today, the short party, let's say it buys the asset today for 72.50. What's the opportunity cost of having bought that asset? The opportunity cost is this interest rate, and since it is essentially guaranteed that the short party needs to sell this asset at a given price after 5 years, we should use the risk-free rate. So that is the logic for using the risk-free rate. So by buying the asset, the short party is forsaking or giving up making a return of 8.25%. So a no arbitrage situation is that he then sells this, or the forward price is simply based on taking the risk-free rate over a 5-year period. Okay, so is this simple enough? Okay, so this is your basic forward contract. Is everybody clear about the price? So if I ask you, so for Fauzan, what do we mean by the price of a forward contract? Yeah, it's the price at which the long will eventually buy the asset on maturity date. And do you think that's written on the contract? So that has to be clear on that's probably the most. What are the 3 most important pieces of information on the contract? Yeah, the asset, the date, and the price. Okay, so those are the 3 most important elements. Okay, is it appropriate to use the term, I heard the term exercise Is that an appropriate term to use? Yeah, you use the term exercising an option. In this context of forwards, does anybody choose what to do, what not to do? No, it's a forward contract is an obligation for both the long and the short. Okay, so nobody is exercising any rights. It's both parties have an obligation because both parties have committed. Okay, now we are going to understand the concept of the value, and I'm going to also explain why this is so important in say the banking sector or in any company where we have to do a mark-to-market exercise even for our various forward contracts. Okay, the key point is this. We got into the forward contract at time 0. The forward contract expires at time T. This big T always stands for when the forward contract expires. The terminology used in the curriculum is F0T, where F stands for a forward contract, 0 stands for when the contract is initiated, time 0, big T stands for the time at which the forward contract matures. Okay, now look at this example. A 2-year forward contract was established with a price of 62.25. Okay, so this is a 2-year forward contract. So the way we can look at this is, so if this is 0, this big T is what? It's 2. Okay, with a price of 62.25. What's the interpretation of 62.25? Yeah, that's the price written on this forward contract. So if this is the forward contract, for the underlying asset, the long will pay this much to the short. Okay, is this the same as the spot price over here? No. Okay, what's the value of the forward contract at time 0? Is this piece of paper worth anything at time 0? The piece of paper, the contract itself is worth nothing at time 0 because this value was determined using a no arbitrage concept, in the sense that when this price was determined, it was based on the risk-free rate in effect at time 0, and it was based on the spot price at time 0. And the 62.5 was arrived at based on the concept that nobody is taking advantage of anybody else. So the value of this contract at time 0, so value at time 0 was 0. Okay, the question now is, as we move through time, will interest rates change? Will the spot price change? Will the forward price change? No. So the forward price is staying the same. The commitment from both the long and the short is that the long will buy from the short at this price, but other variables are changing. The spot price might go through the sky. It might go up a lot. Okay, just as an example. So if the spot price is changing, shouldn't the value of this piece of paper change? Yeah, so, and a principle that you might recall from level 1 is, if the spot price is going up, the guy who is buying the long, doesn't he benefit? Because he has locked in this price. And now if the spot price goes up, the long benefits or the long wins. So over time, if spot price is changing or interest rates are changing, this piece of paper, the forward contract, has value. That value is called value. Okay, when you say price versus value, the value is the value of the piece of paper, that contract, and the price is the price of the underlying asset at maturity. Okay, so make sure you get that distinction. Now, what's the next logical question? Yeah, how do you come up with that value? So let's look at an example. So we are on this 2-year forward contract, was established with a price of 62.25. Now a year and a half later, at time t equal to 1.5. So at t equal to 1.5, the spot price is okay. The time in between is denoted by small t. Okay, big T means maturity. Small t means at some point during the life of the contract. So at small t equal to 1.5, the spot price, so the spot price at time 1.5, is 71.19. So just by looking at this, if you are the long party, are you happy? You are happy because as you know, things might change over the next 6 months, but as things stand right now, you have a commitment to get this item for 62.25, and the spot price already is up to 71.19. So this piece of paper that you proudly hold, where you have a commitment from the short party that he'll sell to you for this, do you think that piece of paper is worth something? It's worth something. You could sell that piece of paper to someone for a price, for a value. How much would you sell that piece of paper for? Okay, now look at it this way. The way this logic works is, this is your spot price right now. I want you to actually think about, before I put down the formula and explain it, I want you to think about how you would come up with the value, and especially write this down on your piece of paper. And if you've already done this before, then don't shout out the answer, so be honest. Okay, but everybody think about how you would come up with the value. You are also given that the risk-free rate is 7%. And note that you have to use this. How much time is left to maturity? 0.5 years. Okay, hopefully you've had a chance to think about this. So think about it this way. The value at time t, so t is what? 1.5 here. So I'll just write this down and hopefully it should make sense. The value at this time is simply the value of the asset, which is 71.19, minus, now again, remember what I said at the beginning of this class, that most of these things will simply boil down to time value of money. You have a commitment that you will be able to get the asset for 62.25 after how long? After half a year, 0.5 years. So what is 62.25 at t equal to 2? What's that worth half a year earlier? So you simply discount that back, right? So 62, so you are comparing the spot price at t1 equal t at this point. So the present value of 62.25 would be 62.25 divided by 1.07 to the power of 0.5. And if you do the math, this should come out to be 11.01. So the value of this piece of paper is 11.01 at this point in time. So what is causing the value to go up? The fact that the spot price has gone up. So the value to the long is 11.01. What's the value to the short? Yeah, the way you should think about these is always remember the formulas based on long, and derivatives in general is a zero-sum game. So if the long has a given benefit, the short will have the exact same loss, and vice versa. Okay, so the simple way to do this is always think long, and then short is the opposite. Okay, so this is the value. So generalizing this, what is the formula for value at time t? The formula will be the spot rate at time t minus the, what does F stand for? This is the forward price. Okay, divided by 1 plus the risk-free rate to the power of, actually the big T minus small t. So in our case, big T is 2 years, which is the overall life of the contract, minus small t is how far into the contract we are. So in our example, big T minus small t is 0.5. So very high probability that you'll see something along these lines on the exam. If you look at curriculum terminology, it seems confusing, but just remember this example. Okay, it's straightforward. Okay, now let's see you do a simple problem. This is example 1 from the curriculum. Let's solve this. So for part A, what you should have got, forward price is equal to the spot price, which is 125.72 into 1 plus the risk-free rate, which is 0.056 0.5625 to the power of, remember the exponent is always in years, and this should have given you 130.99. So that's the forward price. Now suppose the counterparty is willing to engage in such a contract at a forward price of 140. Explain what type of transaction the investor could execute to take advantage of the situation, calculate the rate of return annualized, and explain why the transaction is attractive. Now this is setting the foundation for one of the favorite category of CFA questions, which is around arbitrage. Okay, so if there is a mispricing, how can you take advantage of this? This is a relatively simplistic exercise. Now what's the current spot price? The current spot price is equal to 125.75. So if you can get into a transaction where you buy this asset at 125.75 and some counterparty, for reasons that you don't understand and you don't need to understand, is willing to buy this for you, from you, for 140, and after how much time?
9.
After 9 months. So all you are doing here, is this a guaranteed contract? So we are assuming it's a guaranteed contract. For a moment we are assuming there is no credit risk. Okay, now what's your return on a 9-month basis? So on a 9-month basis, if you do 140 over 125.75 minus 125.75, just figure out that return. That return is 11.36% over 9 months. And I hope everybody knows how to annualize this. When you annualize, you have 1.1136 to the power of 12 over 9 minus 1. So this will give you 0.1543, which is 15.43%. So in an environment where the risk-free rate is 5.6%, you are making a guaranteed return of 15.43. Okay. Yeah, so the question is, suppose the counterparty is willing to engage, explain what type of transaction the investor would execute to take advantage of the situation. So what would you do? So this is, in A, you can take the prices from A. If you go to the market and you see that the spot price is, actually let me step. The question here is whether, whether this is the long party or the short party, because, so earlier, investor holds a title to this. Earlier, is the investor long or short?
Short.
Investor is selling, so he is short. How would somebody take an advantage of this? You would actually take a long position or a short position on the forward contract. You would take a short position on the forward contract, because remember, what's rule number 1 of finance? Buy low, sell high. And actually all of derivatives is a combination of time value of money and buy low, sell high. Okay, what is high? What is overpriced? The forward contract. So you need to sell in the forward market, which means you take a short position. So the way you take advantage of this situation is you take a short position to sell for 140. Okay, some silly counterparty is willing to pay you 140 for this item after 9 months. How much can you buy it for in the current market? You buy it for 125. 125. 9 months later you sell for 140 because he has a contract, and you make a great return of 15% in a market where the risk-free rate is only 5.6%. Okay, next, what do you think you will have to do? You have to do a valuation, and anytime you will get a forward related question on the exam, guaranteed there'll be one segment on pricing. The next question will be on 2 months later, interest rates have changed, spot price has changed, what's the value of the forward contract? So let's look at the data. 2 months, do you remember how long, what was the period of this contract? So your total, so from 0, so T is equal to 9 months, which is 0.75. 2 months later, the price of the asset, so 2 months later you can, is 2 over 12. The spot price is 118.875. The investor would like to evaluate her position with respect to any gain or loss accrued on the forward contract. Determine the market value. So look, this is the market value of the forward contract at this point in time, from the perspective of the investor in A. So what was the perspective of the investor in A? Long or short? Yeah, so you are doing this for a short. When does the short party gain? When the price goes down. Okay, so long gains when the price goes up, short gains when the price goes down. Okay, so what information do you need from the previous segment? The value of the forward contract. So I'll just write that down for you. The forward contract was 130.99. Okay, so you have the forward contract. Now what's the value at this point in time? So what's the question? Okay, the question is, should we take 130 or 140? Imagine that part B was it's a separate question. Now suppose the forward contract is entered at the price you computed in part A. In part A we computed 130.99. So the 140 was just an aberration. It's not normal to find people who will pay you that much. The risk-free rate is 5.625%.
Same as part one.
Yeah. So risk-free rate does not change too much in general. Again, my advice is just memorize the formula from the long perspective, and then given that this investor is short, just switch the sign. So what was the formula for the long? It was the spot price at this time minus the forward contract over 1 plus R and then T minus T. So what's the spot price? The spot price is given as 118.875. What's the forward price? 130.99 divided by 1.05625 to the power of this time now. So 0.75 minus this, which is divided like 7 over 12. If you do the maths, you should get 7.99 or something like that, approximately 8. Now this is the benefit to whom? Long. And they asked from whose perspective? From the short perspective. So for the short, this is long. So for the long, so this 118 minus this, what mathematically this gives us? Plus 7.99 or this gives us minus. Okay. So if this is minus for the long, that means for the short is the opposite of that. So for the short there is a gain of plus 7.99. Okay. So this is our answer to C. Remember, it's all very straightforward. Just need to memorize this formula, learn the logic once, and then apply it. Okay, now this is roughly from level 1. What happens at maturity? So determine the value of the forward contract at expiration, assuming the contract is entered into at the price you computed in A, which was 100 so that was forward was 130.99. The price of the underlying asset is 123.50 at expiration. Okay, so who benefited? Price went down, So the short benefited by how much? 130.99 minus this. Okay, can you use the value formula with the t minus t? Yeah, so yeah, you don't need to, but it's the same. The t minus t becomes 0, anything to the power of 0 is 1. Okay, so it's the same formula, but you don't really need it. 130.99 minus this is the benefit to the short. So for completeness, I'll just so this was section 7 point. So the question is this the benefit to the short on the asset or on the contract? This is the benefit on the contract. So the way you think of it is this piece of paper where you had the short had what commitment? The short had a commitment that he will sell for 130.99. Let's say the short, does this mean that the short must have owned the asset? Not necessarily. If he wanted to, he could. But if he didn't own the asset and he has a contract that says he can sell for this much, then what can he do on expiration date? He can go to the market, buy for 123 and carry it over to the long party, sell it for this. Okay, and make a nice profit of 7.49. Okay, so the point is that this profit came because of the contract. Explain how the investor did on the overall position of both the asset and the forward contract in terms of a rate of return. Okay, so this is simply then calculating how much the investor, if you look at how much money he might have bought the asset for, and then how much he actually got at the end. I would say you do this, look at the example in the curriculum. All they've done is shown that the return that was made was simply the risk-free rate. Okay, we can discuss this over the break if you are not clear. Okay. Now, so what we've discussed so far is your basic asset, and we have hopefully understood the distinction between price and value. What we are now going to do is get a little deeper and take that same concept and apply it first to equity, and then to bonds, and then to interest rates, and then to currency. Okay, so that essentially would cover the whole reading, and then a quick blurb on credit risk. Okay, pricing and valuation formulas for equity forward contracts. The only addition that is going to be made now is an addition that deals with dividends. If you have a equity, so if you get into a forward contract to buy a given stock, if the stock doesn't pay any dividends, then would our calculation and our working be any different from what we just saw? No, because we had an asset, current spot price, you lock in a price in the future. If there are no underlying cash flows, then essentially for even an equity, the same formulas would hold. But most stocks pay a dividend. So if there is a dividend, then how do we deal with that? Okay, so I'm going to again give a formula and then explain the logic and do an example. The forward price, the way you can think of this, if you take a long position, so if you go long and a forward price is set of 100, let's say that the stock is currently trading for 95, and you get into a forward contract to buy that stock for 100 after say 0.5 years. In between, if the stock pays any dividend, will the holder of the forward contract, the long party, benefit or not? Yeah, just because you have a forward contract doesn't mean you own the share, and since you don't own the share, you will not get any dividend. So the way you can think of this is the forward price that will be established is equal to the current stock price. So that's the stock price is like the spot price that we just talked about, minus the present value of dividends over the life of the contract, and that whole thing multiplied by 1 plus r to the power of t. the way you can think of this expression is, earlier we said forward price is equal to spot into 1 plus r to the power of t. Okay. Now, when you have a dividend paying or any cash flow paying asset, this S, which was the spot price, should simply be replaced by S minus the present value of the dividends. Because the way you can think of this is, if at time t you are getting that stock, what you are really getting is something without any intermediate dividend. Does that make sense? When you look at a given stock, say at this point, what is the value of the stock? The value of the stock is the present value of all future dividends. But if you are going to actually get the stock over here, then the dividends that you get during the life of the contract should be removed from the equation, because you are not getting those. How do you remove these dividends? You simply subtract the present value of any dividends during the life of this forward contract. So rather than using the S that we used in the previous slide or the previous example, you replace that with the stock price, the current stock price minus the present value of dividends, and then the rest of the expression stays the same. So that is this way of putting it. A similar expression, so just written in a different way, is, do you remember this formula now? So instead of S, we replace S minus PV, present value of dividends, into 1 plus R to the power of D. The other way of looking at it is, take the current stock price and take it forward at 1 plus R to the power of T, and then subtract the future value. So at this point you can say the value is S into 1 plus R to the power of T, and then just subtract the, so if you are getting some dividend over here, calculate the future value, and essentially you are subtracting the future value of the dividend. So this relationship 1 and 2 are identical. Memorize both, because depending on the data you are given, you might have to use 1 or 2. If you hate memorizing stuff and this doesn't make sense, then you just need to memorize one of these two, and even if you are given the future value of dividends, you will then have to work your way backwards to solve it this way. But my advice is to try and learn both. Okay. Now, how do you think we come up with the value of a forward contract based on equity? So let me just clean this up. Okay, how will you come up with so the concept is again the same. Okay, so this is time 0, this is time t. Okay, so let's say we want to come up with the value at time t. Now again, the way I suggest you memorize this is, you say value at time t. Remember that same formula from before. So it was st minus the forward rate, whatever the forward contract, divided by 1 plus r to the power of t minus t. But instead of st, what do we write? It's the stock price, the price of the stock at this point, minus the present value of any dividends. But it's any dividends that fall in between this period. Okay, so that S is replaced by this, and then the rest of the expression stays the same. 1 plus r to the power of t minus t. Is this memorized? If not, write it down, because we are going to use this in the next question. Make sense? Alright, let's see you apply that concept now. And I'd strongly encourage you to use the sort of number lines that you learnt in level 1 quant. Yeah, so assume a 365-day year. So has anybody calculated the present value of the dividends? So sitting at time 0, there are two dividends. One is 0.75. So on day 50, a dividend of 0.75, and day 140, a dividend again of So what's the present value of the dividends? If you discount this back, add the two, the present value of dividends should come up to 1.48. And just eyeballing this, does this make sense? We have a relatively low risk-free rate, and it should be just a little under 1.50. Okay, so at least this is how I remember this. I hope everybody remembers the first thing we studied. The price of a forward contract is S into 1 plus R to the power of T. What's the S? It's the spot minus the present value of dividends. So it would be 62.50. So it is, imagine it's the stock as the value of the stock if these two dividends were not going to be paid. So 62.50 minus 1.48 multiplied by 1 plus, what's the discount rate? 0.042 to the power of, so 200 over 365, and this is 62.41. So does it make sense? If you get into a forward contract on this stock, the price of the price of the contract is, or the contract price is 62.41. Okay, that's how much the short will. That's how much the short will get. That's how much the long will pay on this day. Okay, so now let's do this. Notice the trend. You will always see this. Part 1 will be coming up with the price. Part 2 will be so many days later, the spot price has changed. What's the value of the forward contract? So now you are on day 75. Do you still need to worry about the dividend that had already been paid? No, so that's gone, done. Okay, now are you worried about the next dividend? So on day 140, the dividend of 0.75, that's going to be important. Okay, so again, the value, at least I like to remember simple things, so is S minus, so that's the spot price at at time t, which is this point, minus what? Okay, the way I like to think of this is, so I just remember this one formula, S minus, and then the forward price over 1 plus R to the power of T minus T. And then since I'm dealing with a dividend paying stock, I need to recognize that instead of this, I should write what? Yeah, I should, so in numbers, this would be, what's the price over here? It's now selling for 55.75, and I need to subtract the present value of this dividend. So this 0.75 needs to be discounted back this many days. So that's 40 plus 65 days. So when I do that, I have, so this is 0.75 divided by 1 plus the discount rate to the power of 65 over 365. So that becomes the spot minus what's the forward price? That was from our previous part, 62.41 divided by what? 1 plus R to the power of what? Yeah, so that's now this amount of time. So you notice that all this is just time value of money. So 1 plus R to the power of, this is how many days? 125. So 125 over 365, you crunch the numbers and what you should get is minus 6.53. Minus 6 point. So this is the value of the, so if this is a negative number, this means that the long lost and the short gained. Okay. It is now expiration day and the stock is worth 58.5. Determine the value of the forward contract at this time. So if the spot price over here is 58.50, what's the value? So who benefited? Yeah, so the price went down, so the short benefited by how much? The forward price, which was 62, so it would be 62.41 minus 58.40, which is 3.91. So this is the benefit to the short. Okay, so that does this. So we are done with this. But what I want to emphasize here is, do you notice the pattern? And this comes over and over. So come up with the price, come up with the value somewhere in the middle of the contract, and then what happens at the end of the contract. So if you get a question like this on the exam, 3 of those 6 questions are going to be these 3, and then there'll be 1/4 on credit risk, which we will see later.